Hello students, myself is Parminder Singh from Prab Kripa classes. Our today's topic is exploring meaning, significance and components of balance of payments. Every country in the present scenario is involved in export and import of certain goods and services. If we are having something in abundance, we may export that goods and services. If we are having some item in shortage in our country may import that goods and services. Sometimes we make investment in foreign countries and sometimes foreigners make investments in our countries. Sometimes the residents of our country give loan to other foreigners and sometimes we our country takes loans from other countries. Sometimes we make one-time transfers to other countries in the form of aid, donations or gifts, and sometimes we receive gifts, donations, aids from other countries. So balance of payment is a systematic record of all the economic transactions which take place between the residents of one country and the rest of the world during a specified period, say 1 year. After going through this course, we will also understand the importance of balance of payments. The facts and figures mentioned in the balance of payments has a lot of meaning for the economists, policymakers and investors. On the basis of the balance of payments figures, economists give their reports whether the economic policies of the government are in the right direction or what is the likely scenario of the economy. The policy makers of the country also decide on the basis of the balance of payments figures what should be done with regard to trade with other countries, with regard to export and import, what should be the policies of the government, whether we should take loan from other countries or we are having enough money so that we can lend to other countries. On the basis of the facts and figures in the balance of payments, the investors also decide whether they should make investment in a particular country, what are the risks and the benefits associated with investing in a particular country, because the balance of payment figures reflect the economic health of the country, whether the country is debt ridden, whether it is having a lot of foreign exchange. After going through this course, we will also understand that balance of payments has three components and not two, because as per the latest accounting standards of IMF, there are three components of balance of payments, that is current account, capital account and financial account. We will also understand that when we are to take into consideration all the economic transactions which take place between the residents of one country and the rest of the world, the amount of transactions is very big. So some sort of errors and omissions are bound to occur when the data is being compiled. So in addition to the three components of balance of payments, there is also an item in the balance of payments statement, and that is error and omissions item. The students will also understand that while in the accounting sense, balance of payments is always balanced because the balance of payment follows the double accounting standards. That is, all the entries are taken as debit and credit. But if we talk in the economic sense, balance of payment is not always equal. That is, both the sides, debit and credit, are not always equal. Sometimes debit may be equal to credit, sometimes debit may be more than credit, and sometimes debit may be less than credit. That is, sometimes foreign exchange which is coming into the country may be more than we receive. Sometimes foreign exchange we receive may be, that is, sometimes outflow of foreign exchange may be equal to inflow of foreign exchange. Sometimes outflow of foreign exchange may be more than inflow of foreign exchange, and sometimes outflow may be less than inflow of foreign exchange. So the balance of payment may be sometimes balanced, sometimes it may be deficit, or sometimes it may be surplus balance of payments on the basis of the amount of net foreign exchange received. Now the topic before us is meaning and significance of balance of payments. Every country has its own resources. It may be having enough food grains so that it may be in a position to export the same to other countries. The same country may be having some items in deficient. That is, it may require, say, fruits or other industrial items from other countries. So it will import that goods from other countries. So in this way, every country is having some sort of export and import with the rest of the world. In the same way, there are also some one-sided payments. How they happen? It may be that one country may be hit by some sort of natural calamity, say earthquake or some other reason. So at that time, the rest of the world comes to aid of the victim country. So these types of payments are called one-sided payments. These may be in the form of grants, foreign aids, even the workers belonging to a particular country may be working in some other countries. They may send remittances to their families. The countries also avail loan from foreign countries, and the country may also give loan to other countries. So in this way, taking of loan and giving of loan, borrowing and lending also happens between the countries. So a lot of economic transaction in this form takes place between one country and the rest of the world. So balance of payment is the record of all these economic transactions which take place between the residents of one country and the rest of the world during a specified period. This specified period is usually 1 year. Suppose this is the country and this is the rest of the world. So all the transactions which are taking place between this country and the rest of the world are regarded as balance of payments. So here it is the definition. Balance of payments is a systematic record of all the economic transactions made between the residents of one country and the rest of the world over a specific period, usually a year. Here one important point is residents of a country. Whether residents means individual residents, individual human beings? No, it is not so. Then what is the meaning? Here the residents means individual residents, business organizations, governments, or the entities of the government working in a particular country. Now, what type of transactions are recorded in balance of payments? As already discussed, there is export and import of goods between one country and other countries. This is recorded. Goods may be in the form of wheat, rice, any other goods which can be seen, touched, that is visible items. There may be also export and import of services between one country and the rest of the world. Such type of economic transactions are also taken into consideration in balance of payments. So services may be banking, insurance, shipping. Fund transfers. Fund transfers means these are a sort of one type of one-sided transactions, such as foreign aid, remittances. Then there are capital transfers, which are related to capital assets, transfer of capital assets. The balance of payments, though we are using the word BOP, you should always write the full form balance of payments. Balance of payments must always balance, meaning that the sum of credits must equal the sum of debits. What it means? If we go through the balance of payments account, it is something like this. On the one side there is debit entries, and on the other side there are credit entries. All the debits and credit entries must be equal. It is theoretical, but in the economic sense there may be difference between the two. Now we come to the point of residents. As already discussed, residents means individual residents, businesses, governments, and its various agencies within the country. Foreign military personnel who are in the country, in the particular country, are not to be taken into consideration in the balance of payments of that country. Tourists which have visited the country are need to be taken into consideration. Migratory workers are also. Even though all these persons work and operate within the domestic territory of the country, it means that though, for example, we are in India. In India, there are a large number of diplomat offices of the other countries. There may be some foreign military personnel. Tourists are also there in India, foreign tourists. Migratory workers belonging to the other countries are also there. Though they are working and operating in India, but they are not to be taken into consideration while we are preparing the balance of payments record. What is the benefit of balance of payments record? The balance of payment record reveals a country's trade competitiveness. If a country has a large number of exports, say it is exporting goods worth rupees 1000 crore, and it is importing only to the tune of 800 crores, it means that country is earning foreign exchange. It is investment. Balance of payment also reveals investment attractiveness. How it reveals? When we will discuss the balance of payment in detail later on, we will come to know that if a large number of foreign investment is coming into the country, as revealed from the balance of payment, it shows that the country is very attractive from the point of view of foreign portfolio investors or foreign investors. Balance of payment also reveals external debt situation. If we are continuously taking loans from the rest of the world to meet the expenses of the country, then it is a sort of problem for a country. All the information which is given in the balance of payments is very important for policymakers, investors. The information given in the balance of payments is the indicator of country's economic health. It also shows its economic relationship with other nations. Now, what is the benefit of balance of payment to government or central bank? After going through the data given in the balance of payments, the government and the central bank or the monetary authority of the country formulates the monetary and physical policies. The data given in the balance of payments shows whether the country is highly dependent on foreign investment or it is having its own resources, or whether it is continuously taking loans, there is debt accumulation, etc. Analysis of balance of payment also helps economists. The economists of the country make projections about what may happen in future from the economy point of view, and what is the likely scenario in future for the economy of the country as a whole. Analysis of BOP also helps the policymakers. Policymakers means, say, government, who formulate the policies for the government, for the whole of the country. It also helps the policymakers to formulate its strategy with regard to exports, investments, imports. BOP figures are also of interest for the investors. Investors means foreign investors. From the balance of payments, they come to the conclusion what are the risks or the benefits which may accrue to them if they make investment in a particular country, whether they should invest or not invest. If the economic health of the country is not good, the country is importing more, foreign reserves are decreasing, economic health is deteriorating, the foreign investors may decide not to make investment. However, if there is stability in the government and the figures of the as revealed by the balance of payment are proper, the foreign investors, foreign portfolio investors or foreign direct investment may come into the country. Now the topic before us is components of balance of payments. Balance of payments is a systematic record of all the economic transactions which take place between the residents of one country and the rest of the world during a specified period. It is a comprehensive accounting statement where we take into account export and import of goods and services, financial transfers, capital transfers, etc. Balance of payment follows the principle of double entry bookkeeping, where every transaction is recorded as a credit and a debit. It is the format of a balance of payments. We are showing you just for knowledge. On one side, we take into account debit entries. It is in negative, that is here credit entries are taken into. Here we have given negative on the debit side. What is the meaning of debit? It means that all outflows of foreign exchange are to be taken into consideration. All the items where outflow of foreign exchange is there, and all the items where inflow of forex is there, foreign exchange, all the items where which result into inflow of foreign exchange, all the items are taken to be taken on the credit side, and all the items, all the transactions which result into the outflow of foreign exchange are to be taken on the debit side. First we take into account export. If a country exports goods, what happens? Suppose we in India export wheat, then foreign exchange will come. So here we will write export of goods. Goods can also be called visibles because goods can be seen, touched. If we import, what it will mean? Import means we will have to pay foreign exchange. So here it will result outflow of foreign exchange, import of goods. In the same way, if we export services like banking, insurance, shipping, etc., then it will result into inflow of foreign exchange. As we will give service to other countries, they will give us foreign exchange. So here it will result into inflow of foreign exchange. Though we are writing forex, you are to read it as foreign exchange. Do not write shortly in exams. Here it is export of services. Services are also known as invisible items. If we import services, that is avail the services from other countries, we will have to pay foreign exchange. So there is outflow of foreign exchange. Then there comes unilateral transfers, or we may call it one-sided transfers. If we send foreign grant, if we give grant or aid to other countries, these are one-sided payment for which we do not get anything in return. If we give, then it means outflow. Unilateral transfers to abroad. If we give transfer to abroad, then it means that we are sending foreign exchange to other countries, outflow of foreign exchange. But if we receive unilateral transfer from abroad, gifts, foreign aid, these are unilateral transfers. Then we may be making some investment in foreign countries and we may receive some sort of profits or income or rent or dividend. So if we receive income from abroad in the form of, say, such as rent or interest for the investment made abroad, then it results into inflow of foreign exchange. But if we have to make payment to abroad, income like rent, interest paid to abroad, if we send money abroad because they have made investments and now the income is flowing to them in the form of rent, interest, dividend, then it means outflow of foreign exchange. It is to be taken on the debit side. Then it is also possible that we may lend to foreign countries. We are having money and we are lending money. So when we lend money, what it means? Foreign exchange goes out. Lending to abroad. But if we lend from abroad, there is inflow of foreign exchange. We may be having money and we make investment abroad. If we make investment abroad, it means outflow of foreign exchange. Investment to abroad, or if we receive investment from abroad, it means inflow of foreign exchange. So in this way, it is broadly a form of balance of payments. How the entries are made in the balance of payments. This is a broad outlook. There may be many more entries which may come in. We are here only discussing the broad view of the same, so that you can understand what is the format of the balance of payments. Now, some persons say that there are only two components, current account and capital account. But as per the latest guidelines of the IMF, as per the accounting standards of the IMF, what are those? We will also discuss later on. There are three components of balance of payments. One is current account, then capital account and financial account. In the current account, we discuss export and import, of goods. Then we also include the transactions which relate to export and import of services. Then we take into account here current transfers, that is one-sided transfers in the form of aid or grants. Then we here also take into consideration income which is earned in the form of rents or interest for investments made abroad, which we have, that is income which is given or which is received from abroad. Here we take into consideration the transactions related to the capital transfers or sale and purchase, or the transactions related to the capital assets. Here we will take into account differential transactions, that is the transactions related to foreign direct investment, foreign portfolio investment, etc. We will discuss all it in detail later on. Here is the reason why we have mentioned three components. Balance of payments has three components. This is as per the new accounting standards specified by the International Monetary Fund. In the sixth edition of Balance of Payments and International Investment Position Manual BPM6, this is the manual of IMF, according to which there are three components of balance of payments. Now IMF is going to revise its manual in March 2025, which will be known by the name BPM6, BPM7. Now all these components, whether it is current account, capital account or financial account, they provide a comprehensive view of the country's economic transactions with the rest of the world. It covers export and import of goods and services. It covers unilateral transfers, that is the current transfers, capital transfers, and financial flows. Now the topic before us is errors and omissions in balance of payments. Balance of payments, we make record of all the economic transactions which take place between the residents of one country and the rest of the world during a specified period. In the residents, we include individual residents, businesses, government, and its offices situated within the country. When we have to make the record of all the transactions which take place between one country and other country, these transactions are likely to be very enormous in numbers. Even for a small shopkeeper, it becomes difficult to keep the record of all its sales and purchases. But in the balance of payment, there are a large number of transactions which take place between one country and other countries as a whole and the rest of the world. So the errors and omissions are bound to happen when the countries compile their data in respect of the economic transactions with the rest of the world, discrepancies are bound to occur due to many reasons, such as there may be some imperfections in data collection. Sometimes they have to make estimates for certain transactions. There may be difference in some compilation methods, or there may be some complexity in the international transactions. So due to all these reasons, there may be some errors and omissions in the data. When we are talking about balance of payments, as per the latest accounting standards of IMF, International Monetary Fund, balance of payment has been divided into three accounts: current account, capital account, and financial account. So in addition to these three accounts, there is also one more element, and it is known as errors and omissions. Why error and omission item is there in balance of payments? It serves as a balancing item in balance of payments to ensure that debit and credit are equal. And errors and omissions entry, there is one entry which pertains to errors and omissions in the balance of payments. For example, if this is the balance of payment record, here it is debit, here it is credit entries, and we have mentioned here, say, current account entries followed by capital account, then we have made the entries of financial account, and at the last there is also the entries pertaining to errors and omissions, so that the debit and credit is balanced. Errors and omissions reflect the inability to record all international transactions accurately. It is not possible to record all the transactions accurately. So this item has been included in the errors and omissions. Now the topic before us is, why is it that balance of payments is always balanced in the accounting sense but not necessarily in the economic sense? In the accounting sense, balance of payment is always balanced. As already discussed, balance of payments has three components: current account, capital account, and financial account. Balance of payments follows the fundamental principle of double entry bookkeeping. That is, on one side we keep debit entries, and on the other side we keep credit entries. So balance of payment is always balanced because it follows the principle of double entry bookkeeping. But in economic sense, balance of payment may be equal or may not be equal. Why? Because economic conditions of the country and policy decisions of the government can result into the surplus or deficit balance of payments. Let us see how it happens. This is the balance of payments statement. Here we keep debit entries, here we keep credit. Here we keep all the entries on the debit side which result into outflow of foreign exchange. Here we, on the credit side, we make entries which result into inflow of foreign exchange. So when it is represented by debit DR, credit is represented by CR. When debit is equal to credit, it means what? That neither foreign exchange has been sent, that foreign exchange sent or foreign exchange received are equal. There is balanced. It means balanced BOP. We may, in other words, say 500 crores is the outflow of foreign exchange. We are taking example, and inflow of foreign exchange is also 500 crore. But if say debit is more than credit, that is outflow is more than inflow, then it is deficit BOP. That is resulting into net outflow of foreign exchange. How it happens? Say 6,000 crores have been sent abroad in the form of foreign exchange, and only 500 crores have been received as inflow. So here it is deficit BOP. When credit is more than debit, that is inflow of foreign exchange is more than outflow. Here we are talking about inflow of foreign exchange. When we are talking about outflow of foreign exchange. When inflow is more than outflow, that is, there is net incoming of foreign exchange. Incoming of foreign exchange exceeds outflow of foreign exchange. In other words, we can say that we have received, say, 6,000 crores inflow, and only 500 crores have been sent. So here it is surplus balance of payments. Here it was balanced BOP. Here it was deficit BOP. Here it is surplus BOP. So when we are talking in accounting sense, debit and credit side of the balance of payment are equal. But when we are talking in economic sense, there may be three situations: balanced BOP, deficit BOP, or surplus BOP. We hope the concept is clear to you. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.